We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back, Deal Junkies. I'm Gabe Johansson, back in the studio with Dane McKinney, Trevor Howard, and Mark Gallegos. The whole stack team is here, and we have a very special guest for you today, Bridger Pennington. Bridger, thanks for being on the show with us today.
Yeah, good to be on, fellas. This is fun. Let's do it.
Now, I'm going to let Dane introduce you, but I will say you have the coolest name I've ever heard. So kudos to your parents. I love your name. Super cool. We don't have to go into the backstory. You already told us that that's a Utah thing, but thanks for being on the show. Dane, why don't you tell us who Bridger is?
I would rather Mark tell us.
Oh, Mark's going to do it.
Mark knows the most about
passing
Bridger.
the ball.
I've been watching Bridger from afar for a long time.
Yeah.
So Bridger is I think a social media, like, just nailing the brand, the messaging, the innovation in the syndication, fundraising, tech, real estate field. So I see him from Instagram lens, building a really quality platform to learn how to start a fund, how to find all of the tools to get a head start, have a really good forum there. I have not worked with his team yet, and I'm really excited to learn about how you got to where you are, the tooling that you guys have expertise in, and just to really learn about you, because you're a young guy that has a really big footprint online. And I actually first found you around 2022. So I'd love to, I don't know exactly how old Fund Launch is, but Fund Launch is what I've watched.
And Fund Launch is the company that you started, right? Founded by yourself, or?
Yeah, I'll give you the 2-minute summary. I started a fund in college. I think this was 2017, 16, 17, somewhere around there. A debt fund. We can dive into that. I was doing small short-term loans. And then, and this came from my dad had ran a massive multi-billion-dollar fund. My brother was an investment funds attorney. So they taught me about funds, which was very helpful. That's how I broke into this space. I pitched my dad for money when I was trying to launch this fund. It's a fun story. I guess we can dive into it if you want, but he turned me down, said no. He goes, if I invest in your fund, it would ruin the experience of you raising money on your own. Your first group of investors is your hardest investors to find. You need to learn this skill on your own. So I went out and raised a small fund. I then raised a second, which is a much bigger fund, and ran this thing. And my dad did not invest, by the way, but was a great mentor and coach for me to figure out, how do you file with the SEC? Anyways, all the intricacies of building a fund. Ran that for a few years. 2019 and 2020, me and a co-founder, Mason, we were like, what if, I bet other people want to learn this. And by the way, we're off market. I didn't go to an Ivy League school. I live in Utah, for crying out loud. I'm not my dad ran a big fund, but he's in Utah as well. He went to the University of Utah, got C's and B's, and was running a $28 billion family of investment funds, all in real estate, by the way. And so we started to make YouTube videos, podcasts that slowly turned into a course that then turned into a full incubator. And to date, so that was 2019 we launched. We just hit the Inc. 5000 of fastest growing companies in America. We're a bootstrap business. We've had over 110,000 people take one of our programs online, learning how investment funds work, private equity, hedge funds, venture capital funds, real estate funds, etc. We've launched roughly 400 funds out of our platform in the last 2.5, 3 years, something like that. So we have an so for example, I'll break it, just simply put, if you guys were building a real estate fund, we have a bunch of free content. We just teach stuff for free. If you want help implementing it, you come to us. We have 5 different law firms, 15 different coaches. We have a pitch deck designer, and we incubate and help you think through all the intricacies of your fund. You then produce and launch your fund, and that's what we do through Fund Launch right now. So that gives you a little summary.
And then where do we sign?
There you go. We'll get you going. But then also to give you background, I sold one of those funds. I currently run 2 funds. Currently I run a crypto investment fund, crypto and blockchain fund, with a great partner that was on the board of Intel for 15 years. We manage about $20 to $25 million in crypto. And then most recently we run a GP stakes fund called Fund Launch Partners. So we found a bunch of these funds were coming out of our incubator, and we thought, why don't we invest into them and partner with them? And so we just built a GP stakes fund. Our average check size is about $2.5 million. We write a check into these firms. We also we grab a stake of the firm. We buy about 5 to 10% of the firm, and we actually run the fund with them. So to date, we've done 13 deals. Anyways, and we're growing. I'll give the last data point and then we can dive in. But last year we reviewed around 1,200 funds. So 1,200 funds applied to work with us through Fund Launch Partners. We have a huge pipeline. We whittled that down to 13 deals we did, which is pretty cool. We're getting about 100 inbounds a month right now, people that want to work with us. And so we're raising a fund 2 to continue this strategy. It's been an incredible strategy. We've done really well with this GP stake strategy. So there's a crash course. That's kind of my background and history, give you a little data.
So just on the note, while we're there, on the 1,200 that you looked at and then the 13 that you invested, are those 13 separate GP partners, or is that 13 deals and like 5 GP partners? Does that make sense?
Oh no, yeah, 13 separate managers in different verticals.
Okay. Gotcha.
So there's a couple in real estate, there's 2 in venture, 1 in private equity, 1 in private credit. These are different managers, and then they have sub verticals underneath them and multiple deals in each one. So GP stakes interesting. It gives you a broad breadth of a lot of assets. So our aggregate portfolio AUM right now is around $300 million between all those managers and growing rapidly. We'll probably be over $1 billion here in the next few months, probably by the end of the year.
Wow. So when you're looking at all those deals, how do you narrow down to those 13? What are like the defining factors that you're deciding on?
Well, it's nice because we have a lot of deals to look at, right? So you can be very picky. So we have our full investment committee. My partner, he ran at AAA, the insurance company. He deployed around $3 billion into emerging managers. He's now a managing director with us. And so our investment committee, we look through every factor you could possibly look at for a manager. But it really comes down to 2 core things. Number one, are they good? Are they good investors? Do they have a great track record? Do they do well with the capital they've already used? And number 2, can they raise capital? Right. So we look at those and then we underwrite both those very in depth. We don't claim to know their strategy better than them. We want to underwrite the managers. But for example, like a manager comes to us once at final due diligence, we do full balance sheet reviews with them. We sit down with them. Okay, walk me through every bank account you own, every asset. I want to know how financially stable you are personally. I mean, we do full background checks. We fly out, do on-sites with them. We're pretty thorough because we can be. We have 1,200 managers to look at. We might as well be thorough. We have a pretty good sized team. And so far it's been extremely well. We have some phenomenal managers in our portfolio.
Very cool.
On the fund launch on the program, what are the different buckets? Like what's the majority of these students or partners you call them? In what industries, is it heavy? Yeah,
45% is real estate. So right up your guys' eye. Almost half are real estate, funds, syndicators, funds, things like that. The next biggest bucket, about 20%, is private equity / a little bit with venture capital. So they're buying businesses, usually small. They're buying laundromats. They're buying their competitors. They're like, I want to buy, this group of competitors, roll them together into my strategy. And then about 10% is hedge funds. Then beneath that would be private credit. And then just funds we call other. Yeah. There's just other. We have the coolest funds you've ever heard of. I'll give you one example. Like we had a guy, he had the largest facility in the United States. They turned cow manure into hydrogen. He currently had a $50 million facility. I think I want to say they were in Wyoming. And he's like, we need to raise another $100 million to open up 2 more facilities because we have this amazing technology. And so they actually did it. They went and raised the money. As of today, I think they're on their 3rd or 4th facility. Really. So we just bucket that as other, but man, we have some really cool people doing very niche things that are just phenomenal. It's a really cool thing. I get to sit here and work with these incredible managers and just see what they're doing. It's really interesting. And our mission, our mission is to democratize Wall Street. I go back to my story a little bit. Like I hate the idea that only people with Ivy League degrees and people that have worked on Wall Street for 30 years can launch funds. And they have to spend $200,000 in legal docs to build a fund. I think that's just ridiculous in 2026. And so our mission is to democratize Wall Street, make high finance accessible to all. Now, should everyone launch a fund? No, for sure not. But can more people launch funds? For sure. Can smart, well-talented, great individuals like yourselves, it sounds like you guys are looking like down this path a little bit. We want to make that barrier to entry way easier. So instead of spending $100,000 on legal docs, could you spend $30,000 or $20,000 or $10,000 or $5,000? Why is that? Why is it $100,000? Why does it take 6 months to build a fund? Could it be 3 months? Could it be 3 weeks? Could it be heck 3 days. So we're building a new platform right now called Fund Launch AI to try to shorten this window like crazy. So that's truly our mission. We want to help more managers, do great things with high finance.
Yeah. So could you speak to our situation specifically? Because we wanted to have you on just because we like to pick people's brain on things we're trying to learn about. So we've been thinking about doing a fund. We're doing individual, like single asset syndications. And the fund seems like easier because you can continually flow money into it rather than doing a deal by deal case. What do you see like when people are deciding in our shoes whether to do a fund, single asset syndications? Because I'm sure you see that quite a bit.
Yeah. Give me a sense of how many deals have you guys done funded by others, not your own funding? How many, have you syndicated deals from investors in the past?
Yeah, only 3. We're doing our 3rd right now. So we were buying most of our stuff with just a JV partner or just on our own.
Okay.
And then we started syndicating real estate because our deal flow was too big and we just needed more capital now to do the amount we want.
Okay. So
Probably
3
like
have been
12
syndicated.
12 million range of funds raised.
Okay. 12 million you've raised so far. Cool. And then how many deals have you guys just done with your own capital or with, I guess you have a JV partner?
Oh, Gabe personally did 200 million in deals before we started doing deals together. I did 30 million. Mark did 40 million in deals. Then Dane did another chunk too.
Cool. And the reason I ask is I'm just kind of gauging, I guess your back, sounds like you guys are very experienced. You've done well. There's kind of 3 categories, obviously just self-funded and then syndication / what we call single asset funds, which are a good bridge sometimes. And then full out blind pool funds would be the big graduated stage. Syndications are great. Like they work well. I tell people to do single asset funds. It's similar concept, similar price. They're just structured more compliantly with the SEC. Because sometimes syndications can go wonky if they're not structured the right way. But it's a great way to build a track record, a base, your team, etc. You move to a fund when a couple things are happening. Number one, you're like, we have built a great system that continuously can just keep doing deals. That's where a fund is like, yeah, we've built a system of all the, why are we dialing for money every time we have a deal every 2 weeks? Let's just do a fund. We have the capital we can roll. Another reason you do a fund is because you want to scale, and scale in a few different ways. Now, don't get me wrong, you can do large syndications, but usually funds allow you a few things. Number one, you can close on deals faster because the money is lined up. You only raise the capital once, right? So it actually takes a load of capital raising off of your team instead of moving on a deal by deal basis. Helps you close faster. I had a mentor. He's like, we had one deal on a Friday. We had one investor not wire in, and we missed the deal, and it hurt our reputation. And to double click on reputation, now that you're a fund, you can work with larger banks and usually get way better debt financing. So your debt load or debt service actually drops significantly when you get to a fund model because you're a large player. You're doing multiple deals. People want to have a relationship with you. Furthermore, on the deal side, people know, oh, this group is always buying deals. We can send consistent deal flow to them and they will fund and transact. And then furthermore, larger allocators generally like to invest into funds because of the process, the compliance, the setup you have to go through to build a fund makes you more, legit, I guess you would say. And so those are some of the reasons why almost everybody ends up in a fund that's successful at real estate, for example. Almost all of them one day end up in a fund for a few of those reasons I just described. But any follow-ups, that's kind of what I would say. So in your situation, I would, you guys have to balance that where you're at. But if you hit one of those categories, I'd say a fund can be a really great vehicle.
Yeah, because we're kind of at the point where we go in a circle. So you don't have enough deals, then you have too many deals, then not enough capital, then you buy all those deals, now you can't operate those deals. And as you scale, you're continually running in that circle. But we feel like we're at the point where we have the deal flow. We just can't raise enough capital for our goals of how many deals we want to do. So we've only done those 2 or 3 syndications over the past year. So we're pretty new to capital raising. So we're trying to explore all our different options. And we tap our friends and family pretty quickly, right? And then they'll go full cycle in their deal, be able to reinvest. But to do our target this year is to do 100 million in deals. We're gonna have to raise probably 20 million-ish to do that. And then we'll buy some on our own still. So it's just thinking through like, okay, what is the best vehicle to get us there? And then how do you, like, you have a really good sales funnel online too. So it's like, how do you model that sales funnel too, if you want to go that route for investors, or like the more one-off large checks? And Dane can kind of share with you kind of what we're thinking there and get your thoughts with the programmatic JV.
Oh yeah, no, I mean, I think what you're saying probably makes sense for us at some point, right? And so it's just kind of to your point, like, when do you do it? Everybody kind of ends up in that bucket as long as they intend to scale and grow. And so my question would be more like, what's the threshold do you think you have to hit before it's like, okay, now it actually makes sense to start a fund as opposed to doing single asset syndication?
Yeah, again, this is up to you guys. I meet with real estate groups like this all the time, and this is the exact discussion. It's like, this is not unusual. And by the way, both sides, there's great pros to both. I don't think there's a wrong answer. The question, this is what my dad would tell you. So my dad, awesome dude, maybe you can have him on the show. He got C's and B's in college. He's my mentor for me, and then end up running a $28 billion family of real estate investment funds. They IPO'd. I think now he's retired. They now manage like 50 billion. They're a top 5 real estate operator in the world. And fund manager. And they had this discussion when they were starting, because they were doing syndications, one-off deals. And the question they sat around was, how big do we want to play? We can make good money doing syndications, and by the way, there's no fault in that. They decided as a team, though, they said, okay, let's build something. Let's build a multi-billion-dollar, fund that buys. We want to buy 1,000 unit apartment complexes. Like, that's a city. We want to buy cities, right? Like, that's that. And that was what they decided. So they said the vehicle to get us there is a fund. We got to figure this fund route thing out. And so they called lawyers, people. Their first, this is what he told me at least, their first fund, a lot of their syndicator investors didn't want to come over. They didn't like the fund model. They pushed back. No, like, John, take us back to we like just doing the one-off deals. And he said, guys, sorry. The only way up for us is through a fund. If you want access to our great deals and returns, guess what? You gotta come and join us as a fund. And he goes, most joined us, a couple didn't. And we were okay with that. We could live with that because we knew we were playing a bigger game. We started getting annual audits, and we paid for a better audit. We got Deloitte, KPMG audits. We didn't have to pay for those, but we did because we wanted to play a big game. We started getting banking relationships, and anyways, you get the point of that was their mission. And in the short term, I think they made less money, for 18 months or 24 months than they would have made syndicating. But then over time, obviously, they made an immense amount of money because they went for the large scale growth. Another example as well is just complexity of K1s and tax documents. When you do a lot of syndications, you got all these deals and side partners and JVs and one-offs, and you promise this guy one thing, and you're doing K1s at the end of the year, and all the accounting is like a mess. When you go to a fund, bam, it's all in one portfolio. It like makes it, you start to simplify. So that's the conversation as a team I would have. Now, a good bridge that I've seen a lot of groups do is this, because it's a big jump to go to a full out fund. You could do a 3-pack. So instead of doing one-off syndication, hey, we're going to raise a syndication or a single asset fund, but we're doing 3 assets, a 3-pack. Or a 5-pack. And then eventually it's like, well, we're doing a 15-pack. It's just called a fund. It's called a blind pool fund. That's kind of where you're moving to. Most funds have 12 to 20 assets in them, maybe 25 assets total. And so a good bridge is you start doing a 3-pack, a 5-pack, and then you move to the full out fund. Is that helpful at all?
Yeah, that is super helpful. Start thinking about, because our plan right now was looking for the bigger check sizes, because it's really like when we're syndicating deals, it's a lot of work to raise $5 million at $100,000 check sizes. And we're operators. Like, we want to go find the deals and operate the deals. We don't want to be fundraising a ton. So we were trying to put together what we call programmatic JV, where we're partnering with like a $10 to $20 million check size to do a specific deal type on repeat over and over again in these metrics. And essentially a fund would just be that with multiple people. Rather, and then you can still place those larger checks within it. And so it sounds like a good option for us.
Yeah, anyway, those are all options that are available. We went through this debate of, we had actually, so this is Fund Launch Partners. We had a group approach us. They were going to give us $100 million check, a fund of one. They said, kick out all your investors. We want to be your only investor. This is last year. And we were like, dang. Like, that's crazy. That sounds really appealing. Like, we were trying to raise our fund one, and we had some money lined up. And as a team, we sat down and we said, well, if we take that one investor, we are now essentially slaves to that investor.
Mhm.
They can determine the points, all the terms come, because if they leave, they have all the leverage. And so we said, it sounds great, but we're going to turn it down. We want to raise from 70 or I can't remember, like 80 investors to raise our 30 million. So we have a lot of different investors. And now that we're raising fund 2, those investors got a great experience in fund 1. They now are telling their friends and family and others, hey, you guys got to check these Fund Launch Partners guys out. And now our fund 2. And so we are growing a bigger firm. We believe that was the route we took. We didn't want to be anchored by one large check. Furthermore, many of those groups, we had, everyone wants to raise from institutions. We met with about 30 institutions for our fund 1. We had 8 that were like in final due diligence. Guess how many invested? 0. Those 8 are still in final. They are like, oh, we like you guys. We got to watch you for like 3 years, 4 years. They want to see 3 years of annual audits. Like, we're just starting. We don't have that. Like, well, see you in 3 years. They still are friends with us. We still hop on the phone. Most institutions, large players, they want to invest by fund 3. And so typically fund 1 and fund 2, you're proving the model so that on fund 3, you have years of financial audited, reports, great returns, and then bigger checks start coming in. And all of a sudden you're now, you're raising 300, 400, 500 million, $1 billion funds for real estate, for example. And you can go, that allows you to buy, much different types of properties. So I'll stop talking.
Yeah.
That's the idea.
So I was curious.
Cap raising. Sorry, I'll give one more note.
Yeah.
You mentioned you guys are all operators, which is great. You've obviously been cap raising so far. You've done well with it. You've raised 12 million. I think you said 11, 12 million. I'd keep doing that. If obviously these are the best investors you're going to have for your fund are the previous investors that already know, like, and trust you guys. That's your best group of investors. When moving to a fund model, though, it's interesting to think through capital raising. You may need to bring on a capital raising partner that they just eat, sleep, and drink capital raising. They are well networked. They're at every charity event. They're at all the Make-A-Wish Foundation events. They're at the political donation rally. They're at, you know what I mean? They're just natural born networker people, and they're going to just bring people into your firm with you. Another way to approach capital raising, sometimes, but by the way, those people are hit and miss sometimes. Sometimes they can raise really well for something else and they won't raise well for you. Route we did was advisors. We brought on they were investors, and then we brought them in as advisors, and they slowly introduced us to their network of people that knew, liked, and trusted them. Now, it took a while. We had to really build that relationship. We had to be someone worth introducing. We had to have a unique edge, a unique place in the market. And so, but overall, my business partner right now is in New York raising capital. He was just in Miami 2 weeks ago. We've already got 30 million raised for fund 1. We just got a commitment of I probably won't say the size, but a massive 8-figure check into our other fund as well. But a lot of that it's been 18 months of relationship building and doing all this, but we're starting to see the ball is really rolling in our direction. But I'll come back to, I'm rambling here, but back to you guys. What I would ask the question for yourselves is, what is our unique edge? What is our right to win in this space? There are plenty of deal junkies that do deals, right? And are in real estate. What makes you guys unique versus any other real estate fund out there that also charges a 2 and 20 and does multifamily and value add, right? And so that's something to really consider. Okay, this makes us unique because we're in a certain market or this asset class or the way we structure our deals. You name it, you guys can figure that out. But that's a question I'd ask yourselves as well. If you really want to scale and play big.
Yeah, I like that.
What is your right to win? I love that. I'm keeping that one.
Well, I've been a fun believer for a long time. I'm just trying to convince you guys. I got way more questions for you, Bridger. I want to change directions if you guys let me.
Go for it.
So
that's how it usually is, bro. There's usually one guy that wants to do the fun and 3 that don't want to do the fun. And this is the argument, and it's a good argument. It's a good argument to have. So
yeah, I'm sure it'll just kind of work itself out in time overall. But I'm insanely impressed with the product you guys have been putting out. So when I first found you in 2022, that was my first syndication. It was a $2 million raise on a new construction project. And I was like, man, this guy's quality is great. And then every year it's like, I'm watching this evolve into this product that is, it's the top of the top. Like the content delivery is perfect. And it's like, I'm just curious on how you have developed and scaled. Cause I mean, I saw on that list, fastest growing companies, like to keep the quality continuously improving, and just what it means for you as a founder, what principles you've learned to keep that growing and continuing in such a short time frame with so much growth. So that just from a founder's perspective, I'm curious.
Are you asking from just content or just in general as a company?
Product as a product fund launch is just like so crisp, start to bottom. Yeah, top to bottom.
Well, I'll tell you a story, and this might frame, my thinking a little bit. I wanted to be a founder. I got into college. I started six businesses my first years of college, and everyone and I mentioned I wholesaled 2 houses. I did Chinese tutoring. I started a 2-year church mission in Taiwan, so I speak Mandarin Chinese pretty fluently. So I was tutoring kids for Chinese. I did website building. I was just doing anything on YouTube that could make money. I was listening to podcasts like yours, like, how do I do deals? Anyways, I found funds took off. I found fund launch, etc. And anyways, my mission statement at the time was like, I'm here to make as much money for Bridger as possible, which I think is a fine mission statement, by the way. People, I'm just going to say it. All these billionaires come to universities, you got to follow your passion, or you got to find something. And it's like, yeah, that's easy to say when you're a billionaire. I'm just trying to make rent, and anyways, and I'm sharing this. This is my mindset, which was, I think actually a decent mindset. I was building businesses. I was making, I was in college. Our first year at Fund Launch, we did 2.5 million in revenue as a college student. My fund was making me multiple hundreds of thousands a year as a college student. I was like, wow. And so I ended up dropping out of school, and I'm like, this is sweet. I'm running. And I'm like, okay, we're going to build this thing and exit. And I'm going to be that. And anyways, I'll fast the story up. A couple years later, we got multiple offers to sell Fund Launch. I got an offer for 20 million, 40 million, and I think 25 million. And when they weren't full offers, they were LOIs. And so we're like, wow. And I'm 27, I think at the time. My business partner's 24. I'm like, wow, we could sell this company for maybe around 30 million bucks. That's awesome. And so, and we had this, we're working with these guys, we're talking about it. And it was this interesting moment and shift of my life of, what am I going to do? And I have a podcast. I interview all these wealthy founders, and many of them, after they sell their business, a couple things happen. Number one, they become very depressed. If you haven't noticed, it's really interesting. Some become suicidal, or they go start another business. Most of them just go start something else. Have you noticed that? It's like, dude, you just sold for all this. Why are you starting another business? And me and Mason, I talked to a lot of guys well, it's the type of people that we are is it's actually very satisfying to build something great and to progress. Progress equals happiness. And I spent the beginning of my life trying to avoid work. I was going to work so much that I'll never have to work again. And the mindset shift for me was, work is good. Work is actually good for the human condition. Humans, and I'm going to use the broad definition of work, where you can work on your golf game, you can work on your garden, you can work on your kids, you can work on a charity, you can work on a business, but work is good for humans. Whenever we don't have work in that broad definition, we are generally very unhappy. And so we looked at each other with this business and we were like, man, if we sold this thing, we'd probably just go build another business just like this. This is pretty cool. And we're young and we have so much time ahead. And I was like, I'm going to work until the day I die, quote unquote. God, if you're a Christian, Adam and Eve, one of the first commandments God gives to Adam is go work, go till the field, go work. So anyways, I'm giving you a long speech here. You don't need this speech, but I sat there work is good. And I love this is really cool. I wonder how good we can get. And let's play a long horizon here. Warren Buffett has made 99% of his net worth after he turned 65 years old. After retirement age. And I'm like, man, I'm 28 years old. How good could we get at this game in 10 years or 20 or 30 years if we really take a long-term view? And I'm in the game of funds, which is a very long-term view. Investors, relationships. If I can build great relationships year after year and compound that, what could this be when in 10 or 20 years, and when I'm 50 years old, which is still 25 years away, right? How that was a weird mindset. And we were like, dude, this is amazing. Let's keep this thing going. We loved what we're working and doing. And so since that moment, we were like, we got to think way bigger. And so you asked about our company, and we're like, okay, we got to build infrastructure. We got to really build like an amazing team that can last. It changed our frame of, and we turned down the offers, by the way, obviously you can tell that. And we said, let's build like fund launch partners. What if we invested into these managers and we dovetailed? Could we be like a $10-billion manager in emerging managers? Right now we're building fund launch AI. I've got 8 devs in my office right now, right behind this wall. We should be out in about 4 or 5 weeks. You guys could model out your entire fund in 15 minutes of how it would look, how the mechanics would look, how like all that stuff. It should be live here in a few months. So anyways, and we'll see if those all work. Maybe they'll all fail. I don't know. But it's fun to be in the game.
Yeah. So it's the
And
pursuit.
I tried to convince myself like work is good. Now, I don't want to work 80 hours a week, right? Like and I want to work on other things throughout my life, but I'm at a point in my life like this is what a time to be alive. And so that was a mindset shift for me. And if you pull this whole story together of why we changed how we did content, it was just this larger frame of reference. We got to build something long term that will last and be great.
Mhm. So how have you instilled that to your team? What is your team size right now, and what has that evolved in 12-month look back? Like what has changed in 12 months, or maybe if there's a longer horizon, but.
Yeah, great question. We got about 75 people on staff total. About 40 are full-time and another 30 are like coaches that are part-time. So 40, and a couple of things that have changed. In office, you got to be here. Remote work, we tried it. We tried it multiple times. It rarely works because we are moving at an incredible pace. Come sit next to me in my office. Like we're working, and I don't have an office. I work out in the open with everybody else. My co-founder does as well. We are working, like you better be here with us. We're doing this. We are building something to last. Our team has had, I would say, a decent chunk of turnover. We use the keepers test on we're a bootstrapped founder-owned business, and we give out rev share and things to people. But we use the keepers test. We stole this from Netflix. They did 2 questions. And this is for your whole team. You do it every 6 months or every year, whenever you want to do it. We go through every person on our team. 2 questions are this. Knowing everything you know today, would you rehire that person today? Yes or no? If this person quit right now, would you beg to keep them? Or would you kind of be happy? You know those people like, oh man, like if they quit today, I kind of would be happy because they're just a problem in my life. If you answer no to either one of those questions, you should actually fire those people immediately in your business. And it's kind of a hard thing to do. We started implementing this and it was like really hard. Like we had a guy on our team, like one of our best friends. I guess not best friend, but a really good friend, really like fun guy in the team. But he was a no on both of those. If he interviewed again today, I would not rehire him. And if he quit today, I wouldn't be that mad about it. And we ended up letting him go. And the like I mentioned, the bar, and we're still friends. Hey, you can come play basketball with us on Wednesday nights. Let's still be friends. But like, we are building something great here. And this is the quality and has jumped immensely. And so it's hard to do that at the same moment as being friends and like you help everybody out and you're with everybody and you're a big team. I like the sports analogy. We're not a family. Companies, we're a big family. It's like, no, we're not. We are a sports team. We're a sports franchise. We are a high performing sports franchise. So we love everybody, but man, if you're going to be on the team, you got to be like Steph Curry. You got to be like Draymond. You got to be good to be on this team. This is a high quality elite team that we are building. And so that's that. If you ask some changes, that's some changes that we've had the last 2 years, and we continually do that. And again, it's easy to say on a podcast. It's hard to do in real life, and it really is hard. But we have tried to set that bar and really follow through with that because we want to build something great.
Yeah. How are you attracting great people into your business?
It's a great question. I got this question just last week from a friend because the last year we've attracted incredible talent to our business. Before that, we had a hard time. I mean, we attracted fine people, but like you're a startup, you don't have any money to pay them. you're also like exploring your own market. And they're like, should I really come work for this guy or not? Like, and finally this last year, we have brought some great talent in. Like I mentioned, my one partner deployed over $4 billion at AAA. My other partner is building Financial AI. He's a PhD. He worked on Google DeepMind and computer science. Incredible individual, in his 50s. Other guy in his mid 40s to 50s. I just turned 30s. Like, why are they coming to work for some 30-year-old kid, quote unquote? And I recognize that. And for a while, honestly, we did not like, it was really hard to find talent. So to answer this question, I believe the last about 18 months, 2 years ago, we started to build a lot of infrastructure for our business. Secondly, we raised our vision immensely of what we were doing. And we had good track record. So we had already had 5 years of good business and good leads and good, but not great, good. But I think these other individuals finally saw that. And we said, hey, here's the vision. We're trying to build a multi-billion-dollar investment firm. We have this great lead flow of fund managers. Can you come partner and be with us? We'll give you some equity, some upside. Come be a part of it. And we finally got some incredible people to say yes. And so I think, I don't know if that's the right answer, but a good foundation, a good vision. And this last year, we've brought in probably 4 or 5 core people that are immensely better at me than what they do. Like at the beginning of my business, I kind of was as good as everyone I hired at their job. I just needed more people that could do things. Like I was as good as them at marketing or whatever, email. Now we have people that are way better than me at all the things they do. And it took me 5 years to get to that point. So I guess that's my answer, but I don't know.
How much of that would you attribute to your personal brand, your business brand, and your social media presence? Do you think that helped build the reputation for people that want to come work with you?
It's a double-edged sword. Some people despise you because of social media. So some people like social media. Some people think it's ridiculous. So it's kind of funny. Social media for me is a double-edged sword. So for the people that joined, yes, they're like, these guys have a big audience. They have a big microphone. So if we launch products into this microphone that are world-class, it will do extremely well. So yes, I think that helped a ton. We've had the opposite though. I've had some people like, hey, your content is just off-putting to me. I don't want to be, you know what I mean? I'm like, well, okay, I guess that's how it is. And I've tried to tailor my content to be a little more professional but we've done, you guys are in the content space. We just try everything. We put out hundreds of ads a month. We do funny ads. We do goofy ads. We do professional ads. We just try everything. And so it is a double-edged sword. So hopefully that answers your question. But I think for the people that have come, yes, the microphone we've had has been a big part of that.
What's the current vision of the company?
So our mission statement, like I mentioned before, is to democratize Wall Street and make high finance for all. So when you couple that with an overall vision, we sit here today. We are currently and I'm talking just Fund Launch. Fund Launch primarily is a coaching / incubator business. So we incubate people to launch their funds and do some coaching. We have some courses. Couple things. Number one, AI is here, and the education / courses value is dropping immensely because you can just go ask an LLM to teach you stuff, right? We recognize that. So we said, how can we be ahead of this curve and actually be with this curve? And so hence why we're building Fund Launch AI. So kind of 2 visions here is Fund Launch AI will look and feel a lot like Shopify, we believe. So we want to have this Shopify moment. If you guys know Shopify, they help you build e-commerce stores. Before Shopify, very few people built websites and e-commerce stores. Like, you had to hire a dev team for $100,000 to build you an e-commerce store. After Shopify, like everyone and their cousin and their dog has a Shopify store, right? Like it's $30 a month and anybody could do it. We think a similar thing could happen with funds. Right now, the barrier to entry to start a fund is immense. It's $100,000, a lot of time. Like you guys are debating this, like how do I build a fund? We're like, could we shorten that gap down to, you could build a full fund in a couple hours? Maybe 3 days, maybe 4 days. You could map it out, see all how it would look. You could have legal done, launched. You could manage your fund all on platform. That's what we're striving for with Fund Launch AI. So that's our vision number 1. And then number 2 is how cool would it be? You're now launched. You mentioned capital raising. We have built a massive engine of money that just places capital into your funds that are, and now we won't do it for everybody, but for good funds, you would be on our platform. And we're like, wow, you guys are really sharp. We can see your reports, your audits. You know what? You've got a $2.5 million check waiting for you right here. Click over, have a call with our team. We want to invest and partner with you guys. Like, what an ecosystem for emerging fund managers. Because those are the two biggest gaps. How do I get launched? And then how do I get the money? We have engines for both of those. And by the way, these are not far away things. We think this will be, what I just described to you, 6 to 8 months from now, maybe a year from now, will be fully functional and running. Depending, bugs can always happen. Things can always derail you, but we're pretty close to that. We have a line of sight to that in a very near future. And we're building that. The capital engine is, I guess I don't want to share these internal things, but we have some really cool things going on in the works. We think that capital engine might be immense here in the next 18 months.
Do you have a goal to take the company public?
No, not at all. If we need to take it public, for sure, but it's actually so interesting right now. You see some huge companies that are private. It sounds way more fun to run a private company than a public company, man. My dad IPO'd his company and he's like, he actually retired the day after they IPO'd. They IPO'd, he got his shares, he liquidated, and it was scheduled. He retired that day because he's like, I do not want to run a public company. You see Databricks, I think they're at $250 billion private company valuation. Obviously SpaceX, OpenAI, $500 billion, Stripe, Canva. These are all private companies over $100 billion. So no, we don't see any plans to go public.
Bridger, on your role as founder and visionary and all those things, what has changed the last, it sounds like very pivotal milestones in the last 2.5 range of years, but over that time frame, from a 12-month period, call it 3 years, last 12 months, how has your role in what you work on a daily basis, how has that evolved? Maybe break and summarize in 12-month chunks, how that's progressed, because it sounds like a lot of movement in those 12 months.
Yeah, it's a good question. And at the beginning, as a founder, you're just in the get stuff done mode. You get everything done, right? And you'll get anybody to work with you. And that's me and my co-founder, we were just scrappy. We're just I'll do it. What needs to get done? I will do it. We're not delegating. We're not putting it on a Zoom call. We got to get launched. So that's kind of how we operated for 3 or 4 years, which is a great thing to do. Because it gets stuff done. That got us, multiple millions of revenue, everything. The last little bit, like you mentioned, you've obviously seen a shift of just the way I communicate right now. It's a lot more vision. It's growth. It's product market fit. It's where we're headed, which is all the fun stuff of business. It's the stuff that everyone wants to do as an entrepreneur. One day, it'd be so cool to just sit in a conference room and plan the future and make money. That sounds great. It took us 6 years of, man, a lot of work to finally get to a moment like that. And what's interesting is you, at the beginning of your business, your tolerance bar of what you do is pretty much zero. You will do anything, what I just mentioned. So your tolerance bar is here. And you're I will just do anything to make this thing happen. What happens as you get, I believe at least, as you get into a bigger company, your tolerance bar completely shifts. I shouldn't be doing anything. I should be delegating everything. And the tolerance of what other people, the work they're doing, is also up to my bar. And you go through this incredibly 180 shift of I will do everything to I will do nothing. And if you do those things at the wrong time, it'll hurt your business. If you do the I will do nothing at the beginning, it'll kill your business. And vice versa. If you're now at our stage and I said, I'll do every job, that would also kill my business. And so right now we've tried to thread that needle. Me and Mason, my partner, we are both college dropouts. And so we actively have this chip on our shoulder of education. We are, it's seemingly every day we're sharing articles, news things, podcasts. You name it, on the education of how do we become great tech founders and fund managers. How do we evolve the person Bridger needs to be in 18 months from now? I got to figure out who that guy is, and I got to become that guy, because the guy I am today is not ready to run the company in 18 months. So I need to kill my current self to become the man that can run that company in 18 months or 2 years. It's a renewal. You guys all know this. You guys run businesses, but it's this renewal process of who you are. I love the quote, people have been in business for 20 years, but they've relived the same year 20 times. They're sometimes less experienced as someone who's been in business for 5 years, who have grown every year. And so we actively think about that and talk about that.
Leveling up. Yeah, it's really good.
No, it makes total sense. I want to talk about crypto, not because I'm super invested in it, but you have a fund that has 25 million. Well, had 25 million. It sounds like maybe there might be a little blip.
Before yesterday.
Yeah, it might be a little blip. But what's the thesis behind that? Why did you decide to run that? I guess.
So yeah, I'll back up a little bit. And my core competency is around running funds. I like to partner with good people who are good operators. So my business partner, Dan, he was on Intel's board of advisors for 17 years, multiple Inc. 500 winner, big technologist, started mining Bitcoin in 2013, had the largest crypto mining facility in the state of Utah in 2014. I mean, this is 12 years ago. Very early in crypto, has done extremely well. Back in 21 and 22, I started buying crypto in 2017, and then we said, hey, what if we built a fund around this? Now, I'll back up. We do not day trade crypto. We invest in the underlying technology of blockchain and crypto. So those are represented a lot of times by coins. We still buy coins, but we try to find things that have really good underlying tech. And that's how we think about it. So we rarely trade, actually. We are more long-term holders of this emerging asset class. And I'll stay on crypto and then I'll back up for a second. Blockchain right now is fascinating. It is one of 5 emerging technology platforms coming out right now, which is so interesting. But blockchain, the idea that, and I'm sure you guys all know blockchain, I have to educate you on blockchain, but how we can move from this old financial system on spreadsheets and one-off servers to a blockchain-based system is fascinating. And this is why even in the last 6 months, you've seen JP Morgan flip their stance on this, Jamie Dimon. Vanguard, Bank of America, BlackRock are all committing. They're saying they want to put their entire portfolios on blockchain. 24/7 stock trading, everything is available, transparent. I mean, this is as significant as when credit cards came out or when online banking came out. Whether you liked online banking or not, some people didn't like. That's too scary. I don't want my money on the computer. It's too freaky. Everyone now uses online banking because it's just a better system. That's how what we believe about blockchain is. It's just a better system. And there's a couple, and I'll go into a couple examples, but just right now, if you're trying to wire money across, a great example is wiring money. If you're in Germany and I was trying to send you $100,000 via wire, well, I go to Wells Fargo, I put a wire request in, it charges $30. It goes to the New York Fed. They change my dollars into euros or German francs, whatever the currency is. It then goes to an intermediate bank, usually in the UK. And then sometimes it's another bank and then ends up in Germany. It takes about 5 business days and $30. There's about a 6% fail rate, by the way. 6% of wires just fail. One of the banks, it just doesn't work and it cancels. You have to restart your wire. Why in 2025 does it take 5 business days and $30 with a 6% error rate for me to send you $100,000 if you're in Germany? You take name XRP, Solana, Ethereum, Bitcoin can do it in 10 minutes. Ethereum could do that transaction in about 45 seconds. XRP could do it in about 20 seconds. Solana could do it in a millisecond. That's how efficient these blockchains are. You can move and transfer assets, and then you take real world assets. So then you take car titles or real estate. Real estate's going to be harder because of countries. But right now, California is looking to digitize 40 million car titles. So what that means is, when you buy a car, you have to, file the stuff with the paperwork with the state and you get your plates like 30 days later. They're putting it all on the Avalanche blockchain, which has a token called AVAX. And theoretically, it's like Venmo or Cash App. Like you have a car, I send you 10 grand. The car title is in my right away. Like it's that moment. And then I could turn around and sell it to somebody else. You could day trade car titles on the system. The same thing could happen with real estate. Real estate's a little harder because you're working with counties and countries that control those real estate, but theoretically it would work just like that. So this is what a fascinating time to be alive. I'm like, I want to park an immense amount of money in front of that tidal wave if I can. which is pretty cool. So
Yeah.
Is that helpful at all?
No, it's super helpful. So I mean, my question on that to follow up, I guess, is if there's four that you mentioned in the different or the times that it would take those transactions between Bitcoin, Ethereum, Solana, and XRP. So like what do you see the future being for all of those? I guess if that makes sense. Like does everybody go to one currency, or do you just have an exchange where you know the exchange rate of all the currencies, and some of them are good at different things? There's different market caps, and those are the advantages. Like I guess I can't see the future in that way.
The answer is I don't know. We will see.
Yeah.
Each token I just mentioned are good at different things, and so and again, these you mentioned they are a currency, but I think of the underlying companies or technologies beneath them. And so you look at different use cases for each one, like international banking, XRP, very good at that. Ethereum has 1.2 million independent node validators. So very good at, if you're launching a sub product like JP Morgan, they're building a tokenized private equity fund. They usually build it on the Ethereum blockchain. You're building a stable coin, you build it on Ethereum's blockchain. Solana is very good at millisecond transactions around the globe. So like tap to pay, like Apple Pay, you would run that on Solana because the way they've built their technology. So that gives you a little, like Avalanche is very good at governance. So that's why California uses Avalanche to do car titles, for example. So each one is different. I think you're going to have a basket of a number, just like tech stocks. Think about when the internet came out. It's actually just like the internet. You had Amazon, Apple, Microsoft. They're all good at different things. Similar thing happens in crypto. Can I share one more thing that I think is just interesting? Just the time we live in. I mentioned there's 5 emerging technology platforms right now, which is crazy. We have blockchain, AI, multi-ionic sequencing, advanced data storage and energy storage, and quantum computing. / robotics. So robotics, quantum is like a tail off. That'd be number 6 if you wanted to add it. It's not really out yet, but robotics. They are converging right now together. We haven't seen this in a very long time. This is this compounding effect of converging technology. So, for example, robots. Like, why don't we have robots like 20 years ago? Well, it's because you need really good energy storage, like batteries, and the batteries just weren't efficient yet. You also need advances, obviously, just in robotics, coupled with AI, advances in AI, and coupled with high-speed internet like 5G. You need all of those things at once to make a robot or a self-driving car work. Because if you just have one without, like if there's not high-speed internet, like your car is just going to lag out and just drive off the road, right? And so what we're seeing right now is this convergence of technologies. The last time we saw this was the internet with the personal computer in the early 2000s. If you look back 100 years, and this comes from Kathy Wood, at the turn of the 1900s, we saw the combustion engine, the electricity, and the telephone all come out in the same about 10 to 15 years. And what happened was the convergence of those technologies, we saw a 5x increase in GDP in the United States. 5x. We went from about 0.5% GDP growth to about 2 to 2.5% GDP growth. And we've stayed there for 100 years. Right now, we're seeing not just 1 or 2, 5, and some people go up to 10, but let's just call it 5. 5 emerging technology platforms all converging at once. We could see massive changes in the economy. That's Howard Lutnick did an interview 2 weeks ago. He's the Secretary of Commerce. He said, he goes, I believe we're going to see 5 or even 6% GDP growth in the United States this year, 2026. To put that into perspective, 6% GDP growth is like China when they had full central planning. Was the top of like growth in China was 6% GDP growth. We just had a 4.3% GDP growth in Q4. We have line of sight to a 5 or even 6% GDP growth this year, especially if we get rate cuts here in June and July. What a time to be alive. And I'm going down this rabbit hole. I just think it's interesting, but what a time to be an entrepreneur. What a time to be in business. What a time to whatever you're working on. Like it's immense. So blockchain is one of those. I like being involved with that. We're building Fall Launch AI to be in front of that one as well. These are massive tidal waves. These don't happen every day. The last time we had one was about 25, 30 years ago. So it's a very interesting time to be alive.
You're very excited. What are you most excited about? Like if you had to pick one bucket to put your fund out in front of, what tidal wave is it this convergence? Are you most stoked on one asset type?
Well, AI obviously is turbocharges all of these things, right? Artificial intelligence turbocharges all of them. And then I look at these and I go, well, where do I have expertise? I had a partner that was really good at blockchain. Let's go into that one. But you see AI mixing with blockchain right now, where agents are getting crypto wallets, things like that's very interesting. And then we're building Fund Launch AI to take a great analogy for AI. We think it's like electricity. And I love this. This came from my business partner actually. He's like, it's kind of like electricity, meaning electricity by itself really isn't useful, but electricity or AI plugged into a chat interface is very useful. That's why ChatGPT, they had AI for a long time, but it only took off when I think it was Chat 3.0, the 3.5 came out that one weekend over Thanksgiving. Then it took off. It was the chat application. We now have image applications. We have video applications. It's like this electricity that went into a refrigerator, into a toaster, or into a cell phone. Like that's when it becomes very exciting. And so the application layer of AI is very interesting right now. So we are sitting here with Fund Launch AI. How can we make something incredibly different and unique, proprietary, not just another chat interface, but we plug this amazing electricity that's being developed every day into this right now. What a cool opportunity that we can plug that into. I mean, we could keep going on that rabbit hole, but like you guys are all real estate. I mean, we're seeing, I don't think it'll take a few more years, but 3D printed homes, you guys have seen that, I'm sure. Obviously robotics are going to, I think, be immense in real estate and construction and housing, but and then you start to mix in all these other smart things that could go on in real estate and, tokenizing real estate, et cetera. I think it's an interesting time. And now that I personally think that's going to take longer than these other ones. It'll probably take 5 or 10 or 15 years to really adopt. But simply put, though, 3D printed homes is such an interesting idea. That's still, it's actually happening right now. I'm sure you guys know people that are doing this where they print. Have you guys seen those? They have the big thing that comes and prints the whole home. Like, what a cool thing. So I don't know. We'll see. And again, I have enough. I recognize I'm an idiot. So like, I know that a lot of the stuff might not work out, but I'm trying to just can I put my boat in front of one of these tidal waves that hopefully will raise the ship?
It's amazing.
Yeah, we're just real estate guys.
We just buy
a bunch
apartments.
of stuff. Yeah.
Man. Well, to bring it back around on the Fund Launch, one question I didn't get to ask was, what are the common characteristics that you see in successful students or successful applicants in? Like, is there a pretty resounding common, process in there? And who they are, their vision?
It's like anything in life. They just get stuff done. I've joined a bunch of coaching groups before. I spent money on programs that were $24,000, $30,000. We had one that was $150,000. Like, I actively am trying to join programs and get educated. There's one that was $250,000 with this great group. But it's all the same. You can get a bunch of info. It's people that get stuff done. So we, as Fund Launch, we help people. We give them the tools, the resources, everything at their disposal to use, but they got to use it. It's still their fund. They got to go make it happen. They got to go launch it. They got to go raise the money. We're going to give them great tools to make them be successful. But it's like anything in life. So,
how do you see most of the people raising capital that you work with? Are they doing it through social media, or what does their funnel typically look like?
Yeah, it's a good question. There's this, again, I've been working with clients now for 6.5, 7 years. Everyone has this perfect idea that they're going to build a funnel and have social media and have leads come in. They're going to call them, and it's going to be this. And I like marketing. I know funnels very well. I've not seen it work. I've only seen it work once or twice with funds. Can it work? Yes. I've seen it in some rare cases. People that already have a big following or whatever, great, it can work. We had Ryan Secco on my show. He spoke at our event. He's Grant Cardone's guy that raises money. They have a great funnel. Fundrise has a great funnel. A couple of them have great funnels. For the majority, 99% of people, it just doesn't work. It's people that already know, like, and trust you. So you raise money from. And if you've tapped out your audience, find other buckets of people that know, like, and trust them. So if you've tapped your buckets, find Bill or Bob or Joe and try to create a great relationship with them and try to engage their people that know, like, and trust them. And you can do that with events, stages, whatever. You can do golf, you can do dinners. Like right now, my partners are in New York hosting a dinner. They spent $5,000 on it. We have this guy named George. He's invited all of his people that know, like, and trust him to this dinner. And by relationship, we are now going to pitch them on this fund. And anyways, that's as much as I've tried so many times. Like, can we automate this? Can we make like a funnel and process a newsletter and those things are all supplemental. Yes, those can help. But at the core of it, people like to meet people. They invest with people that they know, they like, and they trust. And to get people to trust you, that means you follow through on what you say you do. You've proven to others that you follow through with what you say you do. You've done previous deals. You've gotten good results on those deals. You have other people that triangulate that say, oh yeah, I know this person. They're sharp as well. It's as much as we want to funnel it and make it a perfect process. I've rarely seen it work.
You're saying it's relationship and reputation.
Yeah, it's a good way to put it.
Much
Yeah.
transaction.
Yeah.
I have a question for you. It seems like real estate and tech is sort of intersecting with this data center boom. Well, how do you feel about data centers? Do any of your funds invest in data centers?
Oh, it's phenomenal. I mean, the White House has posted $9.6 trillion committed to the United States, mostly in data center and AI infrastructure build, which is just immense. Amazon, AWS, I saw they were building a $10 billion plant in Mississippi. Of the 10 billion, 8.8 billion is going just to like contractors, electricians, contractors, non-IT technical people. What a boom that is. And so 10 billion of 9.8 trillion, right, is like, that's a drop in the bucket. It's hard to compute that large of numbers. I think this is immense opportunity right now for the right people, the right spot. And you guys would know that better than me, but I think it's a cool opportunity.
So this is probably where your 6% GDP is coming from.
Yeah. That's why this is Howard Lutnick. But yes, he's like, we're calling all these, they're already starting fab facilities and other ones right now. We also have these other growths in different parts of the economy, but yeah, it's pretty interesting. We'll see if it hits. Again, he could be wrong, right? He's the Secretary of Commerce and he's obviously very bullish on the market. He could be false, but man, what a time to be doing all that.
Are you bullish on housing?
In what sense?
Just multifamily, what the space that we're in. Like, it's been a very difficult market the last few years where everything else has been going up. Commercial real estate has had really kind of a struggle. Rents have gone flat or gone down, expenses are going up. We've got all the regulations. Do you have a lot of funds that are specifically doing like what we're doing in multifamily?
Yeah, we do. And I'll give my 2 cents, probably all that it's worth. But we have a couple of things that are, I think, trending well for real estate. A new Fed chair, Kevin Warsh. We seemingly should have much lower interest rates. Markets are predicting about a full percentage point lower by July right now, which is pretty significant for real estate. I had a guy in my show named Neil Bawa, excellent person. I'm not sure if you guys have interviewed him.
Yeah, the data scientist.
Oh yeah, if you know him. So he actually just this like 2 weeks ago, he's like, Bridger, I think we've had 3 years of pain in real estate. And we are, I think, approaching 3 years of gain right now. We've gone through a lot of pain the last couple of years in real estate. We could hit a 3 years of gain. Now, again, every market's different. Real estate's local, obviously. But I think we could have some nice tailwinds for real estate here pretty soon. I'll give one different example in single family. We had the highest rate hikes in history, right? In the shortest period of time. Single family homes on a median basis across the United States only fell about 10% from 2020 levels till now. Remember 2020, it like rocketed up. It's only come down about 10% with the rates. I mean, as rates drop, it's like how much pent up demand is there right now for people to buy homes? I know just anecdotally an incredibly number of people that are, I'm waiting till rates drop. I'm going to buy when rates come down. I'm going to get in the market. I think we might see a boom in real estate with significant rate cuts. Now, again, those rate cuts have to come, but then you see, obviously you guys know this, but real estate agents, mortgage brokers, all those people start making money again. It's about 14% of our GDP comes from real estate that have pretty much made little to no money the last 3 years. I think it's somewhat due for the market. That's my take. What do y'all think?
I think you just made me feel a lot better. I went to a presentation the other day. We were talking about, listened to a appraiser talk about the Portland market. And, Oregon has its own challenges. And so, like you said, real estate is local. But there's a lot of fatigue, I think, in our industry between, like you're talking about, mortgage people, real estate brokers. And a lot of that is just because there hasn't been transaction volume. It's just very, very low. But it does feel like, I think some of it might be wishful thinking. There's a lot of fatigue. There's a lot of people getting out of the industry. It was like when it first came, it was like, oh, rates are going to come down. Rates are going to come down. Now it's been long enough to where you might start thinking, well, maybe rates will never come down. So, before, if we would have dropped down a point, if we got back to 5%, 3 years ago, everyone said that, 5%, I'm not buying at 5%. And now I think if rates did come back down in the mid or low fives, that people would start buying houses again.
Yeah, I totally agree. And this has been the Trump administration's big push, right? This whole year is to get rates a 1% or 2% lower. They've put in 2 new Fed governors in, and then Kevin Warsh will take office in May if he's appointed. I mean, pending everything goes fine with their appointment. So I would assume, and then actually you can look at prediction markets. The CME Fed Watch tool actually price in all derivative markets on rate cuts. And the market currently is pricing in about a full percentage point cut by July. So that should give you some, I think that would mean some nice things for the real estate market. We'll see. Yeah.
Do you think
would be
that that's
crazy for asset owners.
in the long term? Do you think that rate level is sustainable in the long term? Just because I know it's hard because you're looking at like historical averages for rates, and we're actually at a pretty reasonable, if not below historic averages right now. And so the idea of dropping another point is like, well, I don't know how that affects us in the long term, right? Like short term, it's good for us. I'm not mad about it, right? That's good. That's good for my portfolio personally. But do you think it, like across the economy, that's sustainable? I think the idea is that in the long term, rates will naturally go down as there's more and more money that can be put into the market. And so the more supply there is for excess capital, the lower rates will naturally be. But I don't know.
It's a great question. Historically, yes, you're completely correct. If you look in the last 30 years, though, with kind of newer monetary policy, it's been much lower. That's where people argue we're kind of in this new world here. The Trump administration has signaled, at least, they would like rates to neutralize about 3.5 to 3.25. They believe, quote unquote, that's a neutral rate for where we're at. And that still gives you enough lever if things really went bad. You could cut down to 1 or 0.5 if you really needed to, but it's not restrictive on the market as well. You've seen Jerome Powell talk about this. We've been in kind of restrictive levels, right? Where we've been, we're going to more neutral levels as far as rate cuts. Now, that's one of the levers the Fed can pull. They can also do, repo rates. They can do. There's a few other things the Fed can do, bond buybacks, et cetera, to drive liquidity. They've done a lot of those already. Rates is kind of the last one. And maybe Jerome Powell has been somewhat political about it. I believe he has been. And so, but I think a 3.25 could be a pretty neutral rate, especially to market. I think the Trump administration shared this pretty publicly, was we're way off market. The United States was at 5% interest rates when the rest of the world averaged around 2.5 to 3. The European Central Bank had already cut 11 times before we had cut once. And so and for a lot of reasons, I guess we probably don't need to dive into. And frankly, I don't really know. I'm just speculating, but I think we're going to, seemingly get rates lower. And Trump had the opportunity to put a new Fed chair, and they've been interviewing Fed chairs for 6 months, and they picked somebody, Kevin Warsh. I would think they're going to follow the Trump plan, right? Unless they just hoodwinked Trump and Scott Bessent. I think they're going to put the Trump plan into place, which would be much lower rates. So yeah. I think that's pretty bullish for the economy. Now, what's interesting is he got put into, he got announced last week, and the market went extremely risk off. Gold and silver fell about 15 trillion in a day. Largest liquidation ever was last Friday in history seemingly because of Kevin Warsh. That was the news headline, because he'll be very hawkish on markets. But I'm just like, man, I don't see Scott Bessent and Trump picking someone being very hawkish when they've been wanting the Fed to be very dovish, and they've been very selective with who they picked. So I don't know. That's me speculating a little bit. Either way, derivative markets are usually pretty accurate. So they're pricing in a pretty good rate cut here by July.
Mm-hmm. No, I'm with you. Wow. Wealth of knowledge. Are we doing 2 episodes? Have we talked about one long one?
Is there anything that you can that you wanted to cover, Bridger, that we haven't covered yet?
Oh man, we've hit a lot of good stuff. I don't know. I will circle back on, and we got it. Oh man, time's flying here.
Yeah.
I'll circle back to one thing on the funds. So why do a fund or not do a fund? I think that's a question you guys are debating right now. I'll hit one more thing for real estate people. So we had a guy come to us. He was flipping homes. So he flipped 4 homes per year. And he was thinking about doing a fund. We set up a fund for him. He launched it. The next year, he flipped 72 homes.
Wow.
Now, think about what happens when you flip 4 to 72 homes. Because, and I'll pause my story here. I was speaking at a real estate event, and I was like, how many people in this crowd have ever said, oh, that person overpaid for a property? Like you're bidding against somebody and they outbid you and you're like, oh, they're idiots. They don't know. They're going to lose their shorts on that deal. They're overpaying. What idiots. And we all leave and go away. And we're like, have you guys ever done this? Like I've done this.
Oh, yeah.
Like, oh, they overpaid, right? And I go, maybe they did overpay. Or maybe they're not playing the same game me and you were playing. Take the 72 homes as a microcosm. You flip 72 homes in a year. Well, guess what? Your average cost per flip drops significantly because you can get volume discounts on carpet and paint and other things. You know, you have the same paint guy. The average cost to paint a house drops because you get a volume play. You get better terms from banks. You get cheaper cost of capital. Actually, you probably don't even need to use hard money lenders anymore. Your cost of capital drops significantly. Furthermore, you have speed. We all know the speed to a deal is massive. You can close on more deals faster and oftentimes get better terms because you have a fund behind you. So you couple those things together, and maybe a normal guy that's buying a duplex can only bid $1 million. But someone with a fund, they can bid 1.1 million or 1.2 million because it pencils out for them. Furthermore, if you go to the bigger side, these larger funds, they could bid $1.72 million on that house because they're pooling together 200 homes in a portfolio for $150 million, and they're going to sell it to a bigger firm for $180 million. Then you go, oh, they're not playing the same game that me and my brother-in-law are playing when we're trying to bid on this duplex. Yeah, it doesn't pencil for us. It does pencil for them. And so that's when I say democratize Wall Street, make high finance accessible to all. That's what I'm talking about. High finance is this it? One other story I'll share. This came up from a mentors fund, and I'll give you rough numbers, but they were bidding on a property that was $100 million. A syndicator came and bid at 99 million. They bid 94 million. He goes, we won the property. We bid 5-6 million below the other bid. There's only 2 bidders. He goes, we won for a couple of reasons. Number one, the syndicator, they needed 180 days to get the money together to close. We could close in 2 weeks. Right? Like that alone, like that won us the deal. And then we had we had already worked with these guys before. We had reputation. It's like, we could buy that deal. We got way better discount just because of the structure of our business. Furthermore, and you guys already know this, but as you do bigger deals, there's also less competition, right? So when there's 100 people that'll bid on a duplex, there's 2 people that'll bid on $100 million apartment complex. You guys already know this, but that's what helps you. I think the fund, that's why the fund model is very attractive. Yes. Is there more work? For sure. Do you have to do audits? You have to be compliant. You have to, 100%. But it's not like, you can figure this out. Like, it's not that crazy. And that's what we help people do. But like, it's not as crazy as it looks. And it's actually really good in a lot of cases because it makes you up level your business. But that's to give you a few more notes. It's a different game that people are playing when they're playing in the fund level. And it's sometimes why you get outbid on certain properties.
So if people want to start a fund with you, what's the best way for them to get in touch?
I tell people, number one, just educate yourselves on funds. So we put out a bunch of free content. I have a free YouTube channel. We have a free course we built. I want people to understand what funds are for free. Once you've understood what a fund is and you want to do a fund, you can join. We have a group called Black Card. You join. That's where we have like our full incubator. So we have 15 coaches. We have 5 different law firms. We have a pitch deck designer that like works with you to build your fund. We walk through a process and go launch your fund. That costs money. So that's what we do. Everything taught is free, and then everything is paid as there. That's fundlaunch.com is the name of the company. Yeah.
Wow. Bridger, this has been mind blowing. Thank you so much for sharing your time and your wisdom with us. You're an incredible young man.
Well, appreciate you guys. And hopefully am I considered a deal junkie now? Hopefully I can be part of the club.
You're in, brother.
Yeah. Oh, man, let's go. I love it.
This isn't college.
Appreciate y'all.
You qualify. All right. Bridger Pennington with Fund Launch. Thanks so much for being on the show today. Deal Junkies, we love you. Please share us with someone you love, and we'll see you next time.